What if the secret to a worry-free retirement wasn't chasing higher returns, but mastering a set of quiet strategies that preserve and enhance wealth long after traditional portfolios falter? While most retirees stick with the tried-and-true 60-40 mix, the ultra-affluent are quietly rewriting the rules, locking in yield, sidestepping taxes, and insulating themselves from market gyrations in ways few ever hear about. They're not loading up on hot tech stocks or timing the next bull run. They're customizing their own indexes to harvest losses on the fly, parking massive cash reserves in ultra-short treasuries that outpace money market funds, and tapping private credit and niche income streams that deliver 7 to 10% yields beyond Wall Street's glare. Meanwhile, sophisticated AI platforms are scanning their accounts in real time to trigger tax loss sales at the smallest dips, squeezing out every dollar of tax alpha that a once-a-year review would miss. When it comes to longevity risk, they're turning to deferred income annuities, policies that begin paying in your 80s at rates far above anything you'd find in the market today, effectively outsourcing the "how long will I live?" question to insurance companies. And they wrap it all with a micro-family office approach, a lean team of tax, legal, and lifestyle pros who coordinate everything from healthcare travel to generational wealth transfer, delivering true concierge planning. It's not about flaunting private jets or exclusive clubs. It's about a behind-the-scenes playbook that shields assets, reduces volatility, and guarantees lifestyle, no headlines required. In this video, we're lifting the veil on 6 of these little-known moves wealthy retirees are already using in 2025. By the end, you'll see that the real edge in retirement isn't outpacing the market, it's outsmarting hidden costs, risks, and taxes that silently erode your savings. Stick around, because the strategies you're about to learn could transform the way you think about your own nest egg. Direct indexing sounds like something only giant hedge funds use, but wealthy retirees are quietly adopting it to slice their tax bills in half. Instead of buying a standard S&P 500 ETF and waiting until tax season to realize losses, they build their own index of individual stocks that mirror the broader market. Then, whenever one of those stocks dips just a little, they sell that position to lock in a tax loss, while immediately replacing it with a similar company to keep their market exposure intact. It's called tax loss harvesting, but done in real time and at scale. Imagine you hold 100 stocks. One of them, a major tech name, falls by 7% on a single earnings miss. A standard investor might shrug and wait for recovery. A wealthy retiree sells that block instantly, capturing the loss to offset gains elsewhere. Within minutes or hours, they swap into a closed substitute, say another large-cap tech stock, so their overall risk stays the same. Over the year, these micro-trades can add up to tens or even hundreds of thousands in losses captured, dollars that directly reduce taxable income dollar for dollar. What seems like a tiny tweak, selling on small dips instead of panicking on big plunges, delivers compounding benefits when you consider 20, 30, even 40% marginal tax rates. And because direct indexing platforms automate the matching of like-kind stocks and monitor wash sale rules, retirees don't spend hours on paperwork. This isn't about outperforming the market, it's about keeping more of your market returns by whittling down your tax drag. And when you're managing a multi-million-dollar portfolio, a persistent drag of even 1% per year can mean hundreds of thousands lost to Uncle Sam. By contrast, direct indexing turns market volatility into an ally, harvesting small dips as tax shields. But don't think this is only for the ultra-rich. As technology costs come down, it's becoming accessible to serious retirees everywhere. Next, discover how they're treating cash like an investment with dynamic short-term treasuries that outpace money market funds. While most retirees park their cash in money market funds or sweep accounts earning next to nothing, wealthy retirees are flipping the script by turning short-term treasuries into their new emergency fund. And in 2025, those tiny maturities are paying better than many low-risk alternatives. Instead of locking cash away for years, they ladder 3- and 6-month treasury bills. Buy a tranche today, another 3 months from now, another 6 months out, and so on. Each bill yields a guaranteed rate set at auction, often north of 4%, and matures into cash with no interest rate risk if yields keep climbing. Then, when each bill comes due, the proceeds roll into a fresh bill at the current top rate. This rolling approach means their cash cushion actually keeps pace with rising rates, while still remaining instantly accessible if an unexpected opportunity or an emergency arises. Contrast that with a one-year CD locked at a lower rate for 12 months or a money market fund whose yield lags treasury rates by half a point or more. For someone managing several million in assets, that gap translates into tens of thousands of dollars in found yield every year. And the agility isn't trivial. If a high-conviction stock or private equity deal comes along, they don't have to break a long-term bond or pay penalties. Their entire cash bucket is sitting in a risk-free instrument, just an online redemption away. Platforms now automate the rollover process, auction bids, settlement timing, reinvestment instructions, so retirees don't have to become their own brokers. What once felt like parking money in the driveway now performs like a short-duration bond fund with zero-duration risk. In a world where every basis point counts, treating your liquid reserves as dynamic income generators instead of static parking spots is a game-changer. And it's one reason the wealthy quietly enjoy yields on their cash that most people only dream of. High-net-worth retirees are no longer satisfied with vanilla bond yields or dividend stocks. They're moving into private credit and niche income streams that promise 7 to 10% returns, and they're doing so with remarkably controlled risk. Rather than by corporate bonds traded on public exchanges, they're committing capital directly to specialty lenders, private fund managers, and real estate debt vehicles. Think senior secured bridge loans to developers, aircraft leasing notes, or financing for renewable energy projects, all structured with covenants, collateral, and priority of pay terms that mimic institutional credit. Because these deals aren't subject to daily market swings, the income isn't correlated with the S&P 500 or Treasury curves. When public markets dip, their private credit allocations keep sending checks even as traditional yields evaporate. And managers typically distribute net interest monthly or quarterly, so retirees enjoy a reliable cash flow without stressing over share price fluctuations. The key is due diligence. Wealthy individuals work with boutique firms that vet each deal thoroughly, negotiate terms directly, and monitor performance on an ongoing basis, access that's out of reach for average investors. They also diversify across dozens of these private positions to avoid concentration risk, capping any single deal at a small percentage of their overall portfolio. The result is an income layer that sits between bonds and equities, triggering moderate volatility only when a specific credit event occurs, and even then, losses are often cushioned by collateral or insurance wraps. For retirees managing multimillion-dollar nest eggs, that incremental yield could mean an extra $50,000 or $100,000 a year tax-adjusted, and with far less head-scratching than chasing the latest tech IPO. And while most people never hear about these privately negotiated agreements, the wealthy have quietly been harvesting this specialized income for years, and they continue to expand these allocations as traditional yields remain historically low. Next, discover how they automate tax loss harvesting in real time to lock down every possible dollar of tax alpha, and why a once-a-year review simply doesn't cut it anymore. Wealthy retirees aren't waiting for December to prune losses. They've deployed AI-driven platforms that continuously scan their portfolios, identify tax loss opportunities, and execute trades in real time. Traditional tax loss harvesting meant reviewing holdings once a year, selling positions that dipped, and replacing them with broad ETFs. Good, but only a one-time fix. Now, sophisticated services integrate with brokerage accounts using algorithms to monitor every price movement. If a holding falls by just 3 to 5% from its previous high, the system flags it, sells the position to lock in a loss, and simultaneously replaces it with a highly correlated security, maintaining market exposure without triggering wash sale rules. This seamless process can happen intraday, capturing losses that would vanish if you waited for the next quarterly review. For a retiree in a 37% tax bracket managing a $5 million portfolio, Harvesting an extra 1% in losses could save nearly $20,000 in federal taxes annually. And because these platforms track wash sale windows automatically, waiting the required 31 days or finding nuanced replacement securities, they eliminate the manual record-keeping that trips up DIY investors. What's more, real-time harvesting dovetails with direct indexing, magnifying its impact. Every small dip across hundreds of individual names becomes a tax shield, not just index-level swings. The result is a consistent drag reduction on taxable gains year in and year out, without the emotional overhead of selling and buying yourself. For wealthy retirees, that means every basis point of market performance remains in their pocket instead of Uncle Sam's quietly compounding over decades. In a landscape where after-tax returns matter more than headline yields, real-time tax loss automation has become a cornerstone strategy, one that's reshaping the retirement playbook behind closed doors. Deferred income annuities have long sat in the shadows of retirement planning, but in 2025, they're enjoying a quiet renaissance among high-net-worth retirees seeking true longevity insurance. Instead of counting on market returns or social programs, wealthy individuals are purchasing income-only annuities in their late 60s that don't kick in until age 85 or even 90, locking in guaranteed lifetime payouts at rates far higher than current bond or CD yields. This shift transfers the risk of outliving your assets to the insurance company while preserving your portfolio's growth potential during your early retirement years. For example, a healthy 68-year-old might pay $200,000 today for an annuity that starts paying $25,000 annually at age 85, equating to a locked-in rate well above 10% once the payments begin. Compare that to feeding the same capital into a bond ladder or dividend portfolio, and the numbers just don't compete, especially when you consider sequence of returns risk in your 80s. Beyond the headline rate, these deferred annuities offer built-in inflation adjustments, survivor options, and in some cases return of premium guarantees, providing options banks or public markets can't match. Critics point to the illiquidity. You can't cash out the contract if a health crisis arises, but elite retirees hedge that by funding annuities with a small portion of assets earmarked purely for longevity risk while keeping the bulk of their nest egg liquid. Ultimately, this is about securing peace of mind, knowing that if you live into your 90s or beyond, you're receiving predictable income that survives market crashes and leaves your legacy plan intact. And because pricing for these products improves with longevity trends and better mortality data, wealthy retirees in 2025 are finding that deferred income annuities have become one of the best-kept secrets in their playbook. The final piece of the wealthy retiree's playbook isn't an investment at all, but a hyper-personalized planning ecosystem. A micro-family office that operates like a concierge for every aspect of retirement. Instead of scattering clients across disparate advisors and spreadsheets, these lean teams centralize all services: tax strategy, estate planning, healthcare navigation, travel logistics, even lifestyle management, under one roof. Imagine having a dedicated tax professional who models your cash flow and tax liability in real time, coordinating with your direct indexing platform to time Roth conversions and optimize capital gains. At the same time, an estate attorney in the same circle updates trusts and beneficiary designations as tax laws shift, ensuring that your legacy plan isn't outdated the moment it's signed. Meanwhile, a healthcare navigator lines up Medicare Advantage options, schedules specialist appointments, and arranges medical travel with negotiated rates, beyond what a single insurance broker might handle. On the lifestyle front, a concierge arranges seasonal rentals, curates volunteer opportunities, and vets nonprofit boards if philanthropy is on your agenda. All of this is wrapped in proactive monitoring. Automated alerts flag critical deadlines, tax filings, RMD calculations, policy renewals, so nothing slips through the cracks. And because the team is small and aligned to your goals, they negotiate fees transparently rather than relying on hidden commissions. The result is a frictionless experience where wealth preservation, tax efficiency, and personal wellness seamlessly integrate. For retirees accustomed to managing complex careers, it's the ultimate peace of mind. Knowing every detail of your financial and personal life is being watched, updated, and optimized. While this level of service was once the domain of ultra-high net worth families, advances in technology and boutique advisory models have made micro-family offices accessible to those with a few million in investable assets, turning retirement into a carefully choreographed lifestyle rather than a series of reactive decisions. In 2025, this all-in-one approach isn't a luxury, it's the defining edge that keeps wealth on track, stress at bay, and life running smoothly from one milestone to the next. Retirement isn't just about having enough money. It's about preserving wealth, maximizing after-tax returns, and enjoying peace of mind when markets wobble or life throws curveballs. The 6 strategies we've uncovered aren't flashy get-rich-quick schemes. They're thoughtful, behind-the-scenes moves that quietly boost income, hedge risks, and lock in savings in ways most investors never consider. Direct indexing transforms market dips into tax shields, capturing losses in real time instead of waiting for a year-end review. Dynamic cash management with short-term treasuries turns your emergency fund into a yield engine that keeps pace with rising rates. Private credit and niche debt streams deliver uncorrelated 7 to 10% returns, giving you income that doesn't vanish when public markets slide. Automated AI-driven tax loss harvesting squeezes every basis point of tax alpha out of your portfolio throughout the year, not just once in December. Deferred income annuities offer true longevity insurance, outsourcing the gamble of how long you'll live to insurers who guarantee income in your 80s at rates no bond can touch. And micro-family office services wrap this all into a concierge experience, coordinating tax, legal, healthcare, lifestyle, and legacy planning so every decision works in harmony. None of these strategies require chasing high-volatility bets or complex exotic trades. Instead, they focus on controlling what you can: taxes, timing, counterparty guarantees, and proactive monitoring so that your retirement plan isn't at the mercy of headlines or human error. If your portfolio still feels too exposed to market dips, too taxed by Uncle Sam, or too dependent on your own bandwidth for paperwork and deadlines, it may be time to explore which of these moves fit your situation. Talk to advisors who understand direct indexing platforms, short-duration debt structures, private credit diligence, and the nuances of deferred annuity contracts. Consider assembling a small, agile team, whether in a formal family office arrangement or through coordinated specialists, to ensure nothing falls through the cracks. Because in 2025, the real edge in retirement isn't hitting a higher return number in your statements. It's keeping more of what you earn, shielding your income from hidden drags, and securing a lifestyle that weathers every market cycle and life transition. The tools and models, once reserved for the ultra-wealthy, are now within reach. Your next chapter deserves more than a passive 60-40th split. It deserves a playbook built for today's era of tax complexity and market volatility so you can live confidently, comfortably, and on your own terms.